They didn't say it when silver was sleepy. They didn't say it when nobody cared. They said it after the market learned how fast silver can move and how brutal it can be when the liquidity disappears. Bank of America's metals desk put a range on the table, $135 to $300 per ounce. And before you roll your eyes, before you call it clickbait, you need to understand what that number really is. Because this is not a price target the way people think. It's not a guess, it's not a vibe, it's not astrology, it's a ratio weapon. And if the ratio snaps, if gold stays high and silver goes high beta, those numbers stop looking insane and start looking like the math nobody wants to face. So tonight, we're doing an emergency breakdown, what BofA actually said and what they didn't say. The mechanism behind 135 as in the darker road to $309. The three scenarios, plausible, aggressive, extreme. The conditions that would make this real or make it fall apart. And by the end, you'll know one thing. Is $309 possible? Yes. Is it guaranteed? No. But the fact a major bank is even mapping that range tells you something. They're not looking at silver like a hobby metal anymore. They're looking at it like a pressure system. What Bank of America actually said? Let's pin the claim to the wall. A recent report summarizing Bank of America's metals research, attributed to Michael Widmer, BofA's head of metals research, frames gold as the primary hedge and performance driver going into 2026 and says silver could top out between 135 and 309 under certain valuation conditions. Now, important detail. That range is not, we forecast silver will be $309 next Tuesday. It's a conditional range. It's a scenario map. And it's rooted in one of the oldest relationships in metals, the gold to silver ratio. At the same time, BofA has also been associated with a bullish gold view, expecting gold to average around $4,538 next year, and seeing a pathway toward $5,000 in 2026, with the Fed being a key risk factor if it stays hawkish. So think about what that means. If gold is high and the ratio compresses, silver doesn't need to walk, silver lunges. That's why this range exists. Not because silver is magically special, but because silver is the smaller market that moves harder when the macro oxygen changes. The one formula that builds the entire 309 story. Here's the whole engine in one line. Silver price, Chorsanch, gold price, gold to silver ratio. That's it. That's the math. If gold is $5,000 and the ratio is 50, silver is $100. If gold is $5,000 and the ratio is 25, silver is $200. If gold is $5,000 and the ratio is 16, silver is $312. So the question isn't, do you believe in 309s? The question is, do you believe the ratio can compress again under the right conditions? Because historically it has. The LBMA's own historical discussion of the gold-silver relationship notes that into early 1980, the ratio fell dramatically, touching around 16 and averaging roughly 17 in that period. That's not a YouTuber. That's not a forum post. That's the bullion market's own professional body describing the extremes. And in more modern data, the ratio has swung wildly across crises and cycles, tracked widely in public market data sets. So when Bank of America puts $309 on the table, they're basically saying, if gold holds near our bullish zone and the ratio ever revisits extreme compression, this is what the calculator spits out. Assume gold, 4,138 average, BofA context. Ratio 60, silver 75.63, ratio 50, silver 90.76, ratio 40, silver 113.45, ratio 33.6, silver 135.0. This is your 135 gate. Assume gold or $5,000 pathway scenario. Ratio 50, silver Sandra $100, ratio 40, silver size 125, ratio 37, silver 135. Ratio 25, silver, so $200, ratio 20, silver, so $250, ratio 16.2, silver 309. This is why $135 is the first checkpoint, and 309 is the ratio goes full 1980 style compression checkpoint. Why silver does this? Silver has a split personality. Gold is mostly monetary, silver is monetary plus industrial, and that's where the violence comes from. When the world goes risk off, gold rises, but when the world goes resource panic plus monetary distrust, silver can rise faster because it becomes a monetary hedge and a strategic industrial input. And here's the twist. That industrial side makes silver fragile. In slowdowns, industrial demand can soften. Some bank commentary has explicitly warned that silver demand can fall if solar usage slows, even while acknowledging deficits can still support prices. Investing.com India And large banks have also argued gold can outperform silver because gold demand is structurally supported by central bank buying, while silver is more tied to industrial cycles. So silver is a fighter with a glass jaw and a sledgehammer. That's why it can deliver insane upside and also deliver nasty pullbacks that psychologically break people. 3 roads: plausible, aggressive, extreme. Now we map it properly. Not hype, not to the moon. We map conditions. Road 1. Plausible, the $100-$135 zone. This is the scenario where gold stays elevated in the $4,500-$5,000 region, consistent with bullish bank expectations. The ratio compresses from wide toward a more normal band. Historically, post-1900, ratios often oscillate in broad ranges, but compression phases happen when silver catches up. This road doesn't require insanity. It requires a macro backdrop that keeps gold strong, a liquidity environment that allows silver to catch up, a narrative shift where investors stop treating silver like a side bet. This is the road where $135 is not magic. It's just gold at $4,500 and a ratio in the mid-30s. That's a big move, yes, but it's not end-of-the-world math. It's reversion plus momentum math. Road 2, aggressive, the $150-$200 zone. Now the ratio has to compress hard. This is where silver starts acting like the high beta version of gold retail piles and late industrial buyers add floor demand. Volatility becomes the marketing. This is also where most people get wrecked, because silver does not climb stairs. It climbs cliffs and falls down elevator shafts. This road needs a more intense mix: strong gold, looser global liquidity. Some kind of supply stress narrative, real or perceived, a trend that starts feeding on itself. In this road, $200 is not a prediction. It's a ratio event: gold $5,000 and ratio 25. Road 3, extreme, the $250-$309 zone. This is the history rhymes road. This is where the ratio revisits the 1980-style compression range, and we know from LBMA discussion that around that era, the ratio touched roughly 16 and averaged about 17. That kind of compression generally does not happen in a calm market. It happens when people stop trusting paper. People stop trusting stability, and the trade becomes a stampede. This road is not smooth. This road looks like violent spikes, blow-off candles, premiums detaching from spot, and a public narrative that turns silver into a battleground asset. That's when the 309 math stops being a joke and starts being the top end of the scenario map. ACT5, the why now, factor 27 Sauro 31 Sardo. So why does this conversation even exist in January 2026? Because precious metals aren't being treated like sleepy hedges right now. We've seen major banks pushing aggressive gold targets, citing falling rates, central bank buying, and macro instability. And some reporting has framed 2025 as a year where silver posted massive gains and deficits were a major storyline, with China's export license requirements described as an upside risk factor. Reuters. That matters, because if the market believes silver supply is structurally constrained, the ratio can compress faster when momentum returns. But again, this is where we stay honest. Some analysts have also argued silver demand can soften if solar manufacturing slows, which could cap upside in normal economic conditions. So the question becomes, is the next phase normal, or is the next phase strategic? That's the dividing line. The 5 checkpoints that tell you if $135-$309 is alive. You don't need insider info, you need signals. Here are 5 checkpoints that tell you whether the $135-$309 scenario is alive. 1. Gold stays elevated. If gold breaks down hard, silver's moon math dies. But if gold holds near bullish bank ranges, the silver calculator stays loaded. 2. The ratio starts trending down, not just bouncing. Don't get hypnotized by one-day moves. You want sustained compression that persists across weeks, tracked in historical ratio datasets. 3. Silver starts outperforming gold on up days, gold up 1%. Silver up 3%, 5%, that is the fingerprint of catch-up. 4. Physical tightness shows up in real-world pricing. When premiums refuse to fall, even as spot dips, that's not bullish vibes, that's friction, that's inventory stress. 5. Volatility becomes the story. This is counterintuitive, but true. In silver, volatility is often the advertising that attracts the next wave of capital. When people who ignored silver suddenly see 8% candles, they don't feel fear first, they feel FOMO. That's how ratio events accelerate. What would kill the $309 story? Now we do the part most videos avoid: invalidation. Here are the big killers: a sustained deflationary slowdown that crushes industrial demand and keeps silver from catching up. A policy environment where real rates stay high and liquidity stays tight. A regime where gold is strong but silver is treated as industrial risk, keeping the ratio wide. And yes, major institutions have made versions of this argument. Gold outperformance driven by central bank demand, and silver upside constrained by industrial demand dynamics like solar cycles. That's why you treat $309 as a tail scenario, not a calendar promise. So, Bank of America's range, $135 to $309, is it still possible? Here's the honest verdict: $135 is plausible if gold stays elevated and the ratio compresses into the mid-30s. Math-driven, not magical. $200 is aggressive and likely requires a more intense liquidity and narrative phase. $309 is extreme, a ratio compression event that historically aligns with mania-like conditions in silver, something the bullion market's own historical discussion shows has happened before. And the real point is not whether 309 happens. The real point is this: when a major bank even puts that range on paper, they're telling you silver is no longer just a metal. It's a system variable, a pressure gauge. And pressure gauges don't move politely. They move right when the system can't afford it. So here's my question to you. If the next squeeze starts with ratio compression, would you recognize it? Or would you dismiss it until the chart is already vertical? Drop a comment. $135 first or $309 endgame? Because once that line is crossed, silver doesn't trend, it reprices.